If history tells us anything, a housing crash is coming. But before we get into this video, make sure you like, comment, subscribe, or gas prices will go up even higher. Home prices have been going down recently. 1 in 5 home sellers dropped their prices. According to Redfin, May marked a 20-point in the housing frenzy as buyers regained some control over the market. Pending sales posted their largest annual decline since spring 2020, while the Redfin Home Buyer Demand Index declined 9% during the 4 weeks ending May 29th. The number of homes for sale climbed to a new high for this year, posting the smallest decline since April 2020. A growing share of sellers are recognizing the new limits to their power. More than 1 in 5 dropped their price, the highest rate since October of 2019. What's crazy is I told people this was going to happen a month ago. You can only stretch the market so far. I mean, this is just like textbook knowledge. America's already having affordability issues with inflations reaching up to 8%, which is, I think, is the second highest it has ever been. And you combine that with the soaring rents and the lack of housing supply, you have an absolute recipe for disaster. The average price of homes being sold in the United States is $507, $800. How the heck is an American supposed to afford this? The average American makes $51,480. Let's review data and let's look at the city with the biggest price cuts, Austin, Texas. This house, which was $550,000, was lowered by $55,000, which is right around a 11% decrease. You may think this isn't a lot. Well, wait till I show you this data. These graphs represent the housing starts in America. As you can see, in 2021, the housing starts wasn't really that high at all. And as you can see, more entering into 2022, except for that 1 month in January, housing starts has been actually pretty through the roof so far. Building more than America has ever built before, probably since 2008. As you can see, February 1.7 million, March 1.728 million, April 1.724 million. Now, with all these houses hitting the market in 6 to 18 months, I will 100% think that deflation is going to happen. And coming along with that is a ever glooming recession, the word that everybody speaks of. But why do I think a recession is going to happen? Well, it begins with this, because increased supply will bring down demand in pre-existing homes, and corporate investors will either sell before this happens or be caught and take a loss. And if they take a loss, they will take a pretty decent loss because, one, they paid over asking price for this house, which will probably leave them dumped over on their equity. Let's look at some more metrics. Now, contrary to popular belief, we have been selling a pretty decent amount of houses, but as we can see, that number has went down. Now, a lot of people might relate this to sellers not wanting to sell, but I personally relate this to affordability issues and rising mortgage rates. And let me tell you why. If we look at the personal savings rate as of April 2022, which is 2 months ago, it has reached 4.4, which is honestly the lowest since September of 2008. Pre-pandemic, we were right around 7 to 8 in terms of personal savings, and then it spiked up because of the pandemic, all the stimulus that was released into the population. Suddenly it just went down. If you want to know the reason why, it's actually pretty simple. Americans can't save as they once was due to inflation and rising gas prices. People are having to use their income and burn up their savings for just living. For example, you can't keep increasing your savings if rent is steady rising. Now, depending on what down payment you're putting on the house, it typically take you a couple years to save up for that down payment. According to this CNBC article, it takes the average person 6.5 years to save up for at least a 20% down payment. Now, I can only imagine how much it is now because this article was released in 2018 and the savings rate was way better than what it is as of right now. Let's look at the retail market. You may be surprised, but this typically can correlate with the housing market because we can see how much people are spending. If you look at this graph from all the different retail stores, you can clearly see that the margins are absolutely terrible. These retail companies have over-ordered on inventory, and what I believe is happening, a deflation is going to happen because this inventory is going to upset demand, and then you're going to see huge price cuts within these real retail industries. Now, This will actually, I think this will actually help people save more, because this could actually combat inflation, open up people's more savings. Now, this last metric I'm about to show you guys is consumer settlement. One thing that is pretty interesting is that consumer settlement is actually at 59.4, and this is a dramatic decline from where it was in 2019. It was up in its 90s. Now, sometimes that when consumer settlement drops so drastically, we usually see a recession. Sometimes, not all the time, but like this right here, 2001, it was up in the hundreds, up in the hundreds, then it dropped dramatically, and then we had a little recession. These little gray lines, state areas, indicates the U.S. recessions. Now, I'm not saying that it's going to happen, but I'm saying the odds are pretty stacked up for it to happen. Not to mention, these real estate investors have been going crazy, purchasing up to 20% of the housing market. This is another reason why the bubble is so big. You can't compete against them because they have all cash. But the thing is, with less buyers now getting onto the market due to higher mortgage rates, investment firms will have to push prices down soon, because like I said, approaching inventory, not to mention foreclosures, and also due to higher property taxes on home. And speaking of foreclosures, let's look at this metric from Black Knight. Foreclosure starts surged sevenfold in January, hitting highest levels in 2 years, though volumes rising still 20% below pre-pandemic levels. Now, granted, this was in January, but it just shows you something. Let's read it. Foreclosure starts rose sharply in January as borrower protections in places throughout the economic recovery began to roll off. 32,900 loans referred to foreclosure in that month, while up significantly from December 4,100. January start volume was still more than 20% below the 42,000 in January 2020, prior to the onset of the COVID-19 pandemic. Roughly half of the month starts were among borrowers who were already delinquent prior to the economic impacts of COVID-19, and half from borrowers who became past due in March 2020 or later. Granted, a lot of these foreclosures were due to the pandemic and people entering forbearance during that time period. But how much of people wouldn't have went into foreclosures if inflation wasn't so high, and also the company that with rising gas prices? There's a lot of technicalities into that, but in that data, but it's still kind of not a good sign. Well, this is going to be the end of the video. Thank you guys so much for watching. And this is to my subscribers. Sometimes I don't read the comments because like I'm kind of scared of, let's say, hate comments. And the reason why I'm kind of scared of hate comments is because I know that me being young is that like a lot of people won't take me serious, and they can say a lot of things that will get to my head. But I appreciate you guys that actually comment and stay watching. I will eventually get to those comments as more as I toughen myself up.